from rising domestic demand in the developed market economies like the U.S. and Japan, which is benefiting from stimulus. So we're looking at areas like Russia as well as Indonesia in terms of areas that are going to benefit, but also not directly in China where there is some moderation in overall Chinese growth. Again, we don't think that Chinese growth is falling off a cliff here, and we're certainly not in the China bear camp, but some moderation should be expected in China.
If interest rates are rising and mortgage rates push some people out of the housing market, doesn't that throw some risk in MBS?
Absolutely. I think, overall, mortgages are, a huge part of the asset purchase program that the quantitative easing program by the Fed right now. However, I think valuation is the most important thing to think about in mortgages, and mortgage risk premiums or spreads are now wider than they were before the Fed embarked on QE3. So you want to understand what you're being paid for the risk you're taking, and I think the QE tapering has already been priced into the mortgage market. We don't buy sort of every mortgage in the market, but we do think there are opportunities in certain pools of mortgages on the agency side, as well as certain non-agency mortgages which benefit as the housing market recovers in the U.S.
What are you outright avoiding, if anything?
We continue to be cautious on the developed market sovereign bonds, specifically Eurozone and Japanese government bonds. We still think there is more yield increase to go in those markets, perhaps similar to what we've seen in the U.S. And also, as the U.S. leads the recovery story, we think the dollar will strengthen against major G10 economies. So we want to be cautious on developed market FX risk in this environment.